Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's Pre-Market Prep. Spencer Israel, as always, joined by Joel Elconin and Dennis Dick. On today's show, it is Cloud Earnings Day. We have earnings from a number of big cloud stocks. We have VMware, Splunk, Ambarella, Palo Alto Networks. In addition to that, we have HPQ, GameStop, reporting what little earnings they have left. In addition to the earnings, we have G20, of course, starting today. We have Marriott with a bit of a data breach issue there. PCG is being examined by regulators in California for a potential breakup. We'll talk about the European banks, talk about whatever you want to talk about in the chat. And our guest today, 8:35, will be joined by Greg Weldon from Weldon Financial. Joel, what is the word here in the overnight session?
A little bit of red here, Spencer. Down 11.5 handles here at 27.32.75. Our pre-market high is right near that closing price. Our closing price was 44.25. Pre-market high 43. So there's a target on the upside. On the downside, your pre-market low 27.29. Yesterday's low about 6 handles lower, 23.25. I'm expecting a little bit of a range-bound day here with the G20 meetings going on. Maybe get a few rips and dips off some Trump tweets, but we'll wait for that. Crude down 80 cents here at 50.65, just clinging to the $50 level. Gold down $3.70 at $12.26.70. Silver in the red by a dime at $14.30. And Bitcoin struggling to hold 4,000. This is the Bitcoin futures down $175 at $3,920. Triple D, how you doing this morning? How are things looking at the pre-market?
We're looking down here a little bit. Weakness overseas here again. I mean, we've been seeing it as of late. Deutsche Bank is down another 25 cents, and our Deutsche Bank indicator is not good because this is now going to challenge the low of the move, which was set just 6 days ago. On the 20th, when everything washed out, we got down to 9.20. Well, we're below that right now at 9.17. I mean, you're talking one of the biggest banks over in Europe, and they're starting to hit the credit of it a little bit too. And if you look at the preferred stock, which trades DKT, DXB, both trending down pretty significantly here now. DXB having an ugly day yesterday, 24.05. So again, when they start hitting the preferreds down, they're starting to get worried that, hey, and maybe this actually isn't safe anymore from a dividend. And actually, I think these are hybrid. These aren't straight up preferred stocks. So DXB and DKT. So they're nervous there. You even got obviously your debt investors, which are a little bit nervous.
All right. Before we get into all the action, you were making some really interesting observations about we were talking about it in the chat last night, and we were talking about it on the pre-market show. Dennis, what I know you trade like every second matters to you in your trading, and you're quick and you notice a lot of things. And tell us what you noticed. Was it yesterday you noticed it?
No, this last week. And I've got a few friends there trade on Thinkorswim, and 72-second delay. The CNBC feed came on Thinkorswim. I don't know why that is. But it just started last week. It was always seemed to be on time, and it just started last week with a significant delay. I checked it with multiple people. And then I was like, okay, well, I'm looking at different ways. I've got, different sources where I can get CNBC from. But I was checking Sirius Satellite Radio, checking, and using and asking everyone. I've been asking everybody. Everybody can say that in the chat. DirecTV. So, and I've been timing all these different delays. DirecTV is 16 seconds delayed. Cable provider, which I have, is different in Canada, obviously, than over there. But I'm finding a 14-second delay. You timed it last night, Joel, and you found 13 to 14 seconds as well on Comcast. I think you're going to lose a little bit with satellites. I think there's always a few seconds that you lose. I just don't remember it being 14 seconds. So I don't know what happened here in the last week and a half, but it's like it's been slowed down to a certain extent, the feed. So just asking the listeners out there, if you time your CNBC, just, tweet at me or, message me in the chat, trying to figure out why, I find all of a sudden a 14-second delay here because this was not this delayed last week. It's farther than it was. So, or 2 weeks ago. I think I started noticing about a week and a half ago. So 14 seconds, the easiest way to do that is look at your CNBC clock, look at your iPhone clock, or look at your trading clock, your world clock, because those are synced. Your NYSE is synced. Like that NYSE closed at 40000. It's right on the money. And your iPhone will be synced to that as well. So if you look at that, look when the time changes in the corner of the CNBC and time the difference. And I'm finding 13 to 14 seconds consistently. I've asked a lot of people here now, and I haven't found anybody faster than 13-second delay. So curious out there. I'm not sure why that is. And like I said, it might be a little bit to do with satellite feeds. Maybe there's probably always a few seconds. I just don't remember it being 14. It seems like a lot. TOS is 72 seconds, Jazz. Well, I've timed TOS.
Yeah,
so TOS is 7. I don't know why. TOS was never that delayed, but it got significantly delayed yesterday or last week because I'm not sure what happened there, but they're significantly delayed now. And maybe that's because of free feed, and I don't know, maybe CNBC wants to charge it. I'm not speculating as to why. I'm just saying I'm seeing a delay here now, and you guys can speculate to why.
It's 14 seconds is an eternity in this.
It's a long time.
It is.
I mean, when they're breaking news on CNBC and you're seeing it 14 seconds later, I mean, yeah, a couple seconds because you got satellite feed going up and down. If anybody knows how this works too, I mean, when you got satellites involved with even, all your cable providers, like years ago, you have satellites involved and everything, but the feed's got to go up. The feed's got to go down. So there's a latency issue there. So it's got to go up, up into the satellite and back down and how long it takes to, scramble up the feed and send it back down to you as a picture. Typically, I know when I'm watching something over antenna, because I have a pretty good antenna on my roof, and I'm watching something over satellite, it's typically 4 to 5 seconds difference. So 14 seconds, though, seems like a lot. So I just don't know why all of a sudden there's a pretty big delay there. So if anybody is more better than 14 seconds, let me know. I'm just curious because I'm trying to figure this out.
Spitter said, will algos get worried over a 0.00?
Well, I'm wondering if the algos don't have any delay at all. Obviously I'm speculating at that too. So maybe there's some algos here that are involved that, some high frequency traders here that could be involved that don't have a 14-second delay. And if they only have a 3 or 4 second delay, well, that's a 10-second edge on the rest of us. Huge. And that's an eternity. So, but maybe there's some other people out there that don't have this delay either. So maybe it's just with satellites. Maybe it's different. So that's why I'm asking the listeners, do we have a 14-second delay on your CNBC?
No. And I mean, does it cost you at all, do you think? Has it been?
If everybody is 14 seconds, it's fine. So if everybody in the whole world is 14 seconds, it's completely fine. I don't think everybody in the whole world is going to be 14-second delay. So if somebody's only 5-second delay or somebody's only a 1-second delay, then they got 13 seconds on the rest of us when CNBC breaks news. And CNBC, it's essential news source. They break news. You got to have it. The people, the commentators, whether you agree with them or not, move stocks. Jim Cramer comes on and pumps the stock. It's going to move the stock. So if you're hearing that 14 seconds, then the next guy, well, that's an issue. So the easiest way, Rob Hood, just people asking to measure the delay, is look at the clock in the corner of your CNBC screen, compare it with your iPhone. When your iPhone changes, let's say, because you don't often see the seconds, when your iPhone changes to like 8:10, and then, because 8:09 right now Eastern, when it changes to 8:10, count the seconds, how long it takes for your CNBC screen. Look at your iPhone and then see, is it 13 or 14 seconds? I'm finding 13 to 14 seconds. So you are finding 13 to 14 seconds, Joel. And like I said, we measured TOS was 72 seconds. I don't know what's going on there. Somebody should probably complain to TOS because that's crazy. But anyways, it wasn't that delayed before. I've just noticed that the delay increased suddenly a couple weeks ago, and I don't know why.
All right. Well, everyone do your own independent study here, and just throw it in the chat when you come up. It's interesting. Little bit.
I mean, we can have a comment. Spinner, and we're just giving a little market structure here. He's saying, HFTs put their servers as close to CME, NASDAQ, NYSE. Yes, they do. They're all in Mahwah, New Jersey, right there, direct connections, because they want to reduce the latency of 7 milliseconds. Well, it takes like 50 milliseconds for you to blink your eye. So, when you're talking 14 seconds, you're talking an eternity. I mean, if a high frequency trader can get that feed, and I'm not saying that's what's happening. We don't know anything yet. We're just trying to figure out why there is delay. And I've just noticed the delay a week and a half ago, so I haven't done enough digging. But I mean, if somebody's getting it 3 or 4 seconds ahead of you, that's an eternity, especially if you're an algorithm. So I'm not sure why all of a sudden it's a little more delayed than it was. But maybe I'm wrong. Maybe it's just my feed. Maybe it's just your feed, Joel. Maybe it's just the other dozen traders that I asked. But I haven't found anybody that's faster than a 13-second delay right now. So I don't know why.
All right. Well, everyone just pop in. We got one person in the Google chat saying they just timed it. It was 14 seconds. So we'll see. I mean,
okay, there you go. It's very consistent. I'm not finding any. I haven't found anybody faster than, and 13, 14 seconds is still subject. So we're both, it's hard for us as a human being to, distinguish between the 13 and a half to 14 seconds. So 13, 14 seconds is what I'm finding pretty consistently. And like I said, if everybody in the whole world is 13 to 14 seconds delay, I don't have a problem with it whatsoever. Maybe that's just the satellite feeds. Maybe that's the way it's scrambled. Maybe it's taking that long. But if somebody's getting it faster, that's where I would have an issue.
And we're coming over your house if you got it faster than 14 seconds.
I want the faster one, sure. If I have 5-10 second lead on everybody else, I'd take it.
Yeah.
But I mean, I don't know. And maybe CNBC, I don't know why, but 2 weeks ago, it started to look slower to me. That's when I noticed it. And I was like, why is it slower? And then I timed it and I was like, I don't remember there being a 14. Maybe there was. Maybe it's just selective perception. There was always a 14-second delay. But I'll tell you, Thinkorswim was never that delayed before, and it's very delayed now. So that got slowed down. So I don't know why. Maybe something's going on, but it's an interesting conversation. We've talked about it for 7-8 minutes, but it's interesting because imagine having, 5, 6, 7-second edge on everybody else, or a 14-second edge on everybody else. That's an eternity. These high frequency traders are paying for, a 0.0, or a 7 millisecond edge. Like that's 0.00007 seconds as opposed to 14 seconds. So interesting. It's an interesting conversation.
All right, let's we got it. Everyone is going to contribute here on that.
One more question, and Risk Slayer making a good point here too. He's saying, there's the CNBC Online, CNBC Pro. I actually had that for a little bit too, and it was slow before too. So maybe they want to sell. Maybe that feed's faster. If somebody can time the CNBC Pro, let me know too. And maybe it's like they want to sell their own feed, and that would be understandable. If they say, hey, you want to buy directly from us, we'll give you a little faster feed. So maybe, nothing wrong with that. If everybody can subscribe to it, I don't have a problem with it. If it's a reasonable price. So anyways, but 14 seconds seems like too long.
Bill Phillips has 12.1 seconds here. So
he timed it. Who's that?
Bill Phillips.
Bill? And Bill, if you're listening here, Bill, can you tell us what you're using? So that's the fastest that I've heard is 12.1 seconds. So that's pretty fast. So maybe he's actually sitting right there at the exchange. He's in New York. He doesn't have the 1 second or the 0.0007 seconds for it to get up here to Detroit. So that's the fastest I've heard is 12.1. So we're getting faster.
All right, so we had some cloud earnings stocks last night, right? Does that kind of coming near the end of earnings season? Let's start out with what do you start out?
Let's start with VMware.
Okay.
Just because they had a great report. So VMware Q3 adjusted EPS $1.56 versus $1.52. Nice. Sales $2.2 versus $2.17 billion. So beats on both, and they raised their guidance for the fiscal year. Their sales guidance was raised from 8.82 to 8.88 billion. They also raised their EPS guidance from $6.14 to $6.22 again. That's for the fiscal year EPS. So a beat and a raise.
I like it. Yeah, I mean up 7 stakes here at 168.42. Is that a new all-time high?
That's pretty close if it isn't.
Yeah.
It is.
Yep. So I mean, what do you do with stocks like this? I'm not chasing it here. I would just keep an eye on the pre-market action. Getting awful close. Did you print 170 yet? I guess that would be my my first question here. If we printed 170, we printed way over 170, Dennis. We got to 177.07, and that stands.
So we're on the comeback a little bit here.
Yeah. So you had sitting that level. 168.42, 168.50 has been your lowest. So I imagine if you start to rally here, I think you'll start to find sellers ahead of that pre-market high. And actually, someone was camping out at 174 here. So I'm coming back on the downside. I have no idea where this thing could stop on a pullback.
And also Workday, another cloud stock reporting here. Spencer, what's the details?
Yep, WDAY after the bell. Q3 EPS 31 cents versus a 14-cent estimate. Sales 743 versus $723 million. So big beats on both EPS and sales for the third quarter. They didn't give guidance, I don't think.
I believe this is close to new all-time highs too. You got a lot of cloud stocks that are making new all-time highs. 157.12. We're 150. So we're kissing up against the all-time high right now. I think we've been above that though, correct, Joel?
Yeah, we were. I was just going to mention that. This is setting up nicely. 161.14 is your pre-market high. You're hanging out at the old former all-time high. So we'll see if we find sellers there again. If not, you can use your half and whole numbers for targets all the way up to your pre-market high. 161.14, and it did trade some pretty good volume on that 15-minute bracket. So some good liquidity here. We'll see what it does off the open.
Also reporting Spelunkster, SPLK. Lots of clouds.
Yep, this is also a good report. Splunk reporting Q3 EPS of 38 cents versus a 32-cent estimate. Sales 480 versus $433 million. So it beats on both. The Q4 sales guidance came in a little bit smidgen light, but the what else did they do? They raised their fiscal year sales guidance for fiscal year 19 and fiscal year 20. So 1 quarter of light guidance won't do much against a guidance raise for 2 fiscal years there. So all in all, that's a good report.
This one
SPLK trading up not as much, and it didn't get as much of a lift. I thought it saw 107 to get higher than that, Joel.
Yeah, someone with a fat finger took it over 110. They took it to 110.78. Which was a big old bracket. They traded 325,000 shares on that one, but immediately came back down. This one for me sets up on the monthly charts a pair of highs at 105.5 area, and that's currently we're trading below that. So for this one, if I had to buy any of these two, going through 105.5, this one is quite a bit off its all-time high. So 105.5, that's my level to keep an eye on in the Splunkster.
Jumping over, just stay with the earnings parade. We might as well go Palo Alto Networks, PANW, big pop for it too. All the earnings stocks popped yesterday. Yeah, a lot of them anyway.
PANW Q1 EPS $1.17 versus $1.05. Sales $656 million versus $631. So again, beat and a beat. Q2 EPS guidance coming in a smidge higher by 1 to 2 cents. Sales guidance is in line. Actually, sales guidance is higher as well. So higher guidance, higher earnings.
Off the highs here, this I saw well into the 180s, and then we're down here at 178 now. What is the high after I was high on this one?
Palo Alto Networks, the pre-market high comes in. They got a little. You might have missed the 184.90 print, Dennis.
I did.
184.90. This was right after settling in at the 178 area. This one kind of has the same look as the Splunk chart. So. If you can clear the area we're trading, I like that 181.71 as well, because that was your high on November 14th.
One thing we're finding very consistent with these earnings is that they all had their initial moves were big. It seems like they all kind of had the big pops and the initial moves, and they all kind of leaked since.
Yep.
There's none of them are holding up near the highs, because sometimes you'll see the earnings, they're poor, then they meander, and then they start crawling up and they're back and making new highs. Those are more, they're all interesting, obviously, but those are the ones that, are showing a lot of strength. Like Twilio that day after it reported, remember, it had the pop, it leaked a little bit, but then it started to crawl back up to the highs. We're not seeing that happen, so that is somewhat concerning on a few of these stocks. That could be a little bit of market forces here. We are having a little bit of a down day here, but a lot of these stocks have run too, so there's also consideration there as well. We had the CRM report, which was great, and you saw Splunk pop $5-6 on that report. You saw Workday pop like $10 on that. Well, maybe not quite 10, but $6 or $7 on that report as well. So a lot of these already had pretty good earnings baked in. So maybe not surprising that when you get another 10 points on Workday or another 12 or 14 that it was at, maybe it's not surprising that it's come back. Did we do Workday?
Yeah, we did.
Yeah, I'm starting to lose track of what I've done here.
Do you own any of these stocks, Dennis? Any of these cloud stocks? I mean, I'm talking.
I wish I did. It's always been a valuation issue for me. I've got a little bit of DVMT, which is VMware indirectly, but now that they're going to take DVMT eventually, it looks like off the board, then I won't have that at all. I'm trying to think if I got any other ones. Not really. I probably should have more. I mean, I have the old ones, like the old stodgy ones like Oracle, but if you can call that, I guess you can't really call that. It's database stuff, but I mean, it works in the cloud. No, not really. And maybe I should, and maybe obviously I should have bought some of these on pullbacks here. But again, I'm a value investor guy, and none of these are value stocks. I think it's trading with a multiple of 30 or 40. I typically don't have in my portfolio.
Okay. All right. Any earnings outside?
Yeah, let's stick with tech. We had a few other ones. Those were the cloud ones. I think we covered them all, but we have a couple other tech ones. So let's do HPQ. They had earnings after the bell yesterday. Q4 EPS 54 cents is in line with estimates. Sales 15.3 versus $15.1 billion. That is higher. Obviously, EPS guidance. EPS guidance was in line. Fiscal year EPS guidance also in line. So inline guidance, inline Q4 EPS, and a slight Q4 sales beat.
Internet feed. What's going on here? What's happened here? Market's rallying hard rally right now. Hard rally. What's up?
I'm looking. Hold on.
Goldman Sachs. I saw this in here. Goldman Sachs says they're predicting more escalation. I don't know what that coming out of Trump dinner.
This is a huge pop market.
Yeah, I mean, Dennis, it's all about the China deal. I mean, it seems like that is what's. I bet you it has to be something. Trump reportedly claimed it.
I mean, they're talking.
Says he would be surprised if China.
They're talking right now.
I've got a headline. Who's Lighthizer? No, that's maybe. I'm trying to figure it out too, guys. Just because it's just happened here. So we're doing the show live. So help us out, chat, if you see. What the catalyst here, but we just popped 8 handles.
He's a U.S. representative. So
okay. There was comments from him, and it flew by my screen so fast that I didn't even have a chance to read it. So I think that's what those comments were. And it said something about, be surprised if the China dinner failed. Is there a dinner going on? Yeah, Lighthizer. That's it. Spinner saying the same thing. So it flew by my screen. Can you quickly just go look through the pro? It'll be in the pro.
Yeah.
Look through quickly and find the. Am I saying it right? Lighthizer?
Yeah. No, that's the same comment that I'm seeing on a bunch of places on Twitter.
That's what it is.
So
okay. So that's what it is.
That's undoubtedly.
So they think there's going to be a deal to be had, basically, right?
I think that's what that quote says.
Chinese stocks absolutely blasting off. Alibaba is up $2 now. It was down. FXI, tracks at EEM. Both taking off. Chinese stocks taking off. FXI is your more direct. See China large cap in there taking off here on this news. So we got live action here for you right now. A lot of big movement here on a lot of these stocks happening here right now.
Yeah, I mean, that is what, the market, if you think about it, the market was worried about interest rates. And what was that? Today is Friday. On Wednesday, you had Jerome Powell coming out a little bit dovish here. And then now, supposed China deal. Is there any... after that, is there anything else to worry about? Get ready for S&P 3000 if we get those issues cleared up, huh?
I don't know about that, but the one thing, and this is a consideration here too, even if we get a deal, we have rallied pretty good from those lows. It's not like we're sitting on the lows anymore. So it might be a matter of how good the deal is, and it might be also a matter of if we rally really significantly ahead of it, it could be one of those buy on rumor, sell on news setups. So just be careful. Just necessarily before, I would say if we were, when we were in the doldrums there a month ago or 3 weeks ago, especially on FXI, if you look at it, when we got down $38, there was going to be a deal that's going to pop no matter what. But we are now up a good 10% from those lows that we set back just a month ago. And if I go back on the FXI to October the 29th, that's probably the same day Baba bottom too. Yeah, 130. So we're up significantly from those lows there now. So it's not as easy of a slam dunk trade that if you get a good deal here with China, that the market's going to blast off into orbit. But obviously right now we're rallying on the prospects that there could be a deal here.
And for me, I'll just be keeping an eye on that close from yesterday, 44.25. We are 7 handles below that right now. You had last week's high right at the 27.50 area. Got through it a little bit yesterday, but instead of trying to focus on the highs and lows, I'm just going to for the remainder this week and early next week, we got to keep making higher closes. And right now, the close of yesterday, 27.44 That's the bogey on the upside. You can look at for the equivalent in the SPY as well. For the SPY, that would be 273.98.
So quickly just finish up the earnings stocks here. Yeah. So GameStop, GME, disappointing. I don't know if anybody's surprised by this one. It ran up into the report to a certain extent. I'm just looking the last 6 days from 12 up to 15. It could re-challenge those lows. We're down to 13.25. But again, they've been buying the pullback on some of these stocks. But I don't know if GameStop fits the bill of a retailer that I ever wanted to own. I love the gaming stocks. I think, you've got a big market for gaming. I just don't think people need a physical store to go buy their games in anymore.
No.
So that's why I'm not a fan of GameStop.
I was at the mall on Black Friday. I walked past the GameStop. I sent a picture to Nick Donato, and he said they'll be dead. And he follows the space closely. He said they'll be dead within 3 years. But GameStop, but it was crowded. But it was also Black.
Was it
Friday.
busy?
It was also Black Friday. But yes, it was crowded. All right, the Q3 EPS here beat 67 cents versus 57 cents. Sales beat as well, but the guidance was bad, I think, as expected, because it's always bad. I feel like they see their total sales for the year down 2 to 6%. Comps are going to be either flat to down 5%. That's the range they gave. Whenever comps are down and total sales are down on a year-over-year basis, never a good sign.
Revisiting the lows of the move here, your initial dip took you down to 12.55. You don't have to be a market mathematician to see the lows of the move here at 12.14, 12.31. So that whole area, lower $12 handle, I would look at that as support, and you've already bounced out of there. I don't even know if you're going to get a chance to buy it down there again, but that's where I'm seeing pre-market low coinciding with the lows of the move that you had recently in November.
Is that 11%? Is it still paying that dividend? I'm showing 11.39% dividend on this. Is that still good? Like sometimes they take a little bit to adjust, but are they still paying that big dividend?
That's still good. I think it is. Yeah.
Yeah. So anyways, whenever you see something, and Kramer always makes this point, it's a good point. You see some 8, 9, 10% dividend, usually those dividends aren't safe because people don't just allow 11% dividends to happen. I mean, if it was safe, I'd be throwing all my money in it too. I don't know if it's safe at all.
It's there for now, but it's
there for now.
I
the same reason like GE, you say, people are coming and buying for 4 or 5% dividend, and then they cut the dividend, and then they cut it again. Now what is the dividend on GE? It slashed almost nothing, didn't they, GE? What is it, nickel or something?
It's a penny.
They took it to a penny.
Yeah.
All right.
So, anyways.
Biggest gainer on my filters here this morning is Ambarella, AMBA. The Q3 adjusted EPS there, 21 cents versus a 9-cent estimate. Sales of 57 million, which is in line with estimates there, but it is my biggest gainer, at least last I checked.
Remember this always moved with GoPro back in the day when GoPro actually was like, it'd be like GoPro was the $90 stock and Ambarella like, GoPro, and then Ambarella take off on a GoPro. And I mean, Ambarella's its own thing now because we know GoPro kind of, is obviously not a market mover like it used to be. And AMBA, obviously held up not bad. Considering though, it's still, when you look at these other stocks here, Ambarella, $65 a high, 66 back in January. It's had a really bad year. Here you are, you're $33. So you're basically been cut in half, down 50% this year. I don't know, and we're up 38, and we're up $4 here this morning. So I guess we're getting a little bit of those losses back, but it's been an underperformer.
And your pre-market high actually is a double top at 39.58. So if you go into rally mode, but I'm looking at a daily high here that's kind of sticking out like a sore thumb at 38.65. We're trading right below that level now. So I'd give it all the way up to 39 as potential resistance. And then you have the pre-market high. Besides that, maybe think of like a psychological number like 40 with that 39.80 to 40 area. On a pullback, I don't know. We're kind of just trading at the low of that area right now, 37.65. I'd call that very, very minor support.
Big Lots was Big Lots due to report? I had it on I have calendar. My calendar always messes up Big Lots. It's not due to report, is it?
No, they're not.
No, I don't know why. But my calendar for some reason always has Big Lots wrong. I gotta I remembered that actually as I have it written down. I was like, my calendar's always wrong. Big Lots. Hewlett Packard, HPQ.
We did that. We did that.
That one. Yep.
We did.
Yes.
I don't remember doing.
It's
I wasn't paying attention to Hewlett Packard so much. I like that stuff.
You're too busy trading. But what about Marriott?
PVH.
Okay, fine. PVH. That's
where were you gonna go?
That's the last earnings one that I had on my list. So we might as well.
Might as well. It was down more. It's bouncing a little bit here. Yeah. So, but the trend. Holy cow! Is not your friend on this. Anyways, PVH details.
Yeah. All right. Pull chart here. PVH Q3 EPS $3.21 versus a $3.14 estimate. Sales $2.52 versus $2.53 billion. So mixed report, but they are raising their guidance for the fiscal year. The EPS guidance was raised on the low end of the range from $9.20 to $9.33, which is in line with the estimate there. Guidance raise is usually a good thing. Mixed report there, but I don't know. I don't know this tape.
Boy, oh boy, oh boy.
It's bounced from the lows. How low we get?
Oh, we got low. We got under $100, 99.05.
They like to take them through the big whole psychological levels and then bounce them back. Like I've actually used to play that trade. When you see something, come down significantly, it almost always goes through the whole number, the big 100 level, shows a 99 print, and then they take it back up through it. And the main reason for that is, there's going to be stops down there. If you could push it around a little bit, and I think big money does push stocks around, when you take it through 100, you're going to hit some stops. Take the stops, and then, take them back up, and it bounces back over it. Now, after hours, typically, there isn't stops in place, so that doesn't really apply. So I'm just saying regular trading session. But a lot of times it's psychological levels too. People are like, okay, I don't hold for it's gone, or 100, I'm going to sell. So, there can be mental stops there too. Remember, always under at certain levels as well. And it's just a big psych to take it out at 100. So they often take it out, and often you see it bounce back up over it.
And I'll just give you the rebound high off that 99.01 low, and that is 107 even. So that is just a very, very minor resistance point. Longer term for this one, I'll be looking at 106.63 as that stood as the former low of the move. So, and actually that pop up to that 107 kind of represents that area as well. So keeping an eye on the old low, I don't think you'll get back under 100 today. I think people kind of tried to buy it and missed it when it was under 100, and I think they'll be backing and filling in this one a little bit. PVH, though, long-term chart, not looking too good.
What about Marriott here? Reported that about 500 million of their guests in their Starwood reservation database had their information exposed, both personal information and payment information, credit card information. 500 million is a big number there. They're a hit in the stock this morning.
These hackers are out of hand lately. It seems like you're always getting these data breaches here. I mean, this is just scary.
I don't think it's that. I think honestly, it's just most people for most firms, cybersecurity is a reactive thing, not a proactive thing. It's a pain in the butt to be, to keep your information secure, and it's not. Most people are not.
Well, it's costly too.
Exactly, and most people are not proactive about it. They're reactive, and so that's what you get. When the entire thing, when it's a chore, it's expensive, it's a chore, it slows you down. So you can understand why people don't want to do it, but they pay the price.
I mean, data is just worth so much money. Like when you get all that information, you can sell all that information, and obviously, there's hackers out there that will get that, extract it, and sell it. So if they can get in there and get to like something like a Marriott or there, it's worth a lot of money. So, I mean, there's a lot of criminal activities that go on, and we're in this new world of information age, and that information is worth a lot of money. So you're going to see this stuff continue to happen.
Okay. All right. Let's see here. 834, Dennis. Anything with the imbalances here? After a quick pop here.
They're pretty big to the sell side here. Now, again, there might be some orders before we had the pop in the market. But I'll just give you a couple of highlights there. And AT&T, which has news, and we'll talk about that in a second. 135,000 to sell. It's early yet, though. And AT&T's already traded a ton of stock, so I don't think that's going to really impact it that much. I see Pfizer 172,000 to sell. That's of note. Pfizer actually had a great day yesterday, kissing up near its 52-week high. GE, always a sell and bounce, 263,000 shares. Although that did hit $8 yesterday.
You did, I know.
Did you see that?
I know.
I said that on the show. When I was pulling back in the 760s, I was like, I think, I'm a buyer. I didn't do it, but I was like, I like this on a pullback, and I think it's got room to 8. It kissed 8 right on the kisser. Now it's back at 775, so I only gave you like 1 second there at 8. But anyway, it's funny. It kissed 8 right on the kisser. These big whole numbers work, guys.
Yeah, they sure do. All right, it is 8:35. Spencer, what do we got on the down?
We have our guest, who I will be calling in a moment here, Greg Weldon from Weldon Financial, longtime friend of the show. So we'll be right back in a moment with Mr. Weldon. All right, and we are back now with Greg Weldon from Weldon Financial. Greg, how's it going today?
It's going great, man. How you guys doing?
We're doing all right. We're doing all right. So we've got this G20 thing. Oh, got to mute us in the background. The old radio trick there. Got to mute us in the background. We've got the G20 going right now. We've already had some comments this morning that have moved markets from various people. What do you expect their market's reaction will be today, tomorrow, Monday around this meeting?
Well, sure. Obviously, if you get some kind of agreement with China, the market will take it positively. That comes right on the heels of a very positive reaction to Federal Chair Powell's comments this week. And I think obviously the market would rally. But the bigger picture question is, how far does this rally go? Are we talking about going to new highs? I think that's maybe overly optimistic because to me, you got to put this week into perspective. All right. You've had this big sell-off. People are really kind of just searching for anything to grab onto that's positive here. Not to say these things aren't positive, but relative to what's going on, a trade deal with China, when you look at the deficit, $375 billion, when you look at the amount of exports to the U.S., around 10% of GDP, even if you were to narrow the gap to zero with China, you're talking less than 2% of GDP. So when you talk about the Fed, the Fed just basically said, well, we're almost to neutral. All right. Basically, Powell really didn't tell us anything we already didn't know. I mean, inflation has kind of receded. So neutral's fallen, all right, a little bit. So I think that's part of the puzzle that people are missing. And when you say this is a really kind of positive thing, it's positive to the degree they're going to stop raising rates. It's not positive to the degree that the Fed is thinking stimulus. It's not positive to the degree that you would get from a QE announcement. A trade deal is not fiscal stimulus. All right. So the biggest positive out there is the impact on the consumer from falling energy prices. And I don't really hear anyone talking about that. But that is the only, to me, real positive. It kind of complicates the Fed's thought process if you take it to the next step, which is it will support the consumer and, bring inflation down. So maybe, you have your growth impetus that the Fed's worried that we might lose against inflation that's coming down that would say you've done enough to get to neutral. So that might allow the economy to grow. Now, if that situation played out, that would be a positive. But I think even there, it's just not enough when you start to talk about the U.S. being a global engine of growth. I don't see that. I just don't see it. When you start to kind of scan the landscape, you got some real serious issues out there that are not going to go away. You have a massive housing bubble in Australia that no one's talking about, very few people. I mean, the big hedge fund guys are talking about it, but you have the mortgage companies breaking down. You have the Australian banks breaking down. You have a real overcooked consumer and household debt dynamic in Australia that is coming home to roost here. You have this situation that's evolved very quickly again between Russia and the Ukraine, so and let alone what you have going on in Europe. Mario Draghi spoke this week. Not many people talked about that either, but his comments were very interesting and specific around we see growth slowing. What is the ECB going to do if they face some kind of slowdown? All right, inflation's already falling, but growth is falling faster to where now real growth in Europe is negative. And when you have a German 3-month yield, all right, the 3-month rate is minus 75 basis points, which is 35 basis points below the official policy rate, which is negative. And when you compare it to German inflation of 2.5, you have a negative real 3-month rate of more than 300 basis points to the negative. So I see a lot of issues out there that are not solved by a trade deal with China or the Fed no longer raising rates. The damage has already kind of been done to the consumer. So thank God there's relief from energy prices because the consumer is now paying just for interest payments. Credit card rates, the average credit card on payable balances is 16.6 now. That's up from 11% in 2013. The amount of money consumers are spending to pay just to float their credit, which is at a record level, unprecedented growth in the last 39 months, is $350 billion a month. That is, compared to retail sales, I mean, you are a bigger and bigger and bigger chunk of retail sales and at some point it crowds out discretionary spending. So, this is all good what we've seen. I don't think that this is the kind of backdrop that is going to provide the base, the foundation, and then the impetus for growth that's going to drive the stock market to another bull leg here. I just don't see it.
In spite of all that, though, in spite of all those issues you just named, is this this doesn't seem like a fear-driven market to me?
Well, no, and here's kind of the way I think it might play out. And of course, what we do here, and the hedge fund guys that are my clients, I mean, we create scenarios, and this way, when you start to kind of see something evolve that seems familiar to you, because you've discussed it, you kind of recognize it. I could see a case here where you get some enthusiasm. You get a trade deal here, right? The Fed's kind of said, maybe one more hike and we're on pause, and that's fair relative to where inflation is. That might create an environment here where you try and drive stocks to the upside, okay? Dollar down is a bigger deal to me, number one. You can see the impact already in some of the commodities, which have just been filleted this year, right? Particularly agricultural, soft tropical commodities, stuff like coffee, sugar, soybeans, record crops, the whole 9 yards. So, that's a dynamic that's interesting to me too. But as it relates to the stock market, I see it kind of boosting stocks, but I don't see the growth impetus. I mean, I don't think if you look at the Fed, they haven't downsized their growth expectations. They're still around 4.5% to 5% nominal GDP growth for next year. I mean, who doesn't think that that's kind of ridiculous? So to kind of reach the expectations and to get this stock market where it's another bull leg, I think what you have happen is you kind of suck people back in, you get the shorts out of the market, and all of a sudden you don't have the growth, and you start to bleed. And the next thing you know, see, to me, it's always been like, this is not going to be a crash. It's too obvious. This is going to be some kind of move like this, a rally, and then kind of everyone gets lulled to sleep and the market just bleeds to the downside. Next thing you know, you're testing these lows. And the other thing I'll throw in there too, in terms of U.S. stock market, in this rally that we've seen this week, the PNQI, which is your retail internet portfolio ETF, and the semiconductors have lagged. These have been your leaders, okay, since 2009, along with the consumer discretionary. Really, these three specifically. And they kind of rolled over first and have led to the downside, and they're lagging on this rally. To me, that's really notable in terms of what is the inherent strength here. And that plays into what I'm talking about fundamentally. You don't have inherent strength right here. You don't have QE. You don't have fiscal stimulus. None of those things are going to emanate from the Fed no longer hiking rates or a trade deal with China.
We're on the regarding the Australian housing.
Sorry, you're breaking up.
Regarding the Australian housing bubble, you got me? Did we lose Greg?
I'm sorry, can you say that again? You cut out. I had to take my headset off.
Okay. Just regarding the Australian housing bubble, and you saying that coming to roost in the United States, are you saying that from the perspective that we have some bank exposure over there, or are you more implying that you see another housing bubble evolving in our country?
No, neither one of those. And I didn't specifically say this would come to roost in the U.S. I said it would come to roost soon. I mean, it comes to roost in Australia. And when you start to talk about the number of places where you have issues, again, it's kind of like central banks to a large degree are frozen. I mean, what's the BOJ going to do? What's the ECB going to do? What's even the Bank of England going to do? Maybe China has some room. Maybe Australia's created a little bit of room for themselves. But in the face of what's clearly a housing bubble in Australia, it's not even really debatable when you look at the statistics. It's as bad as the U.S., if not worse, in 2006 and 2007 by some metrics.
I mean, you could say the same thing about Canada too, right? Because Canada, and I'm Canadian. I mean, the housing price in Canada have been crazy over the last number of years. And you think with interest rates going up, eventually this bubble's going to burst, but it hasn't seemed to burst yet. I mean, what's going to be the catalyst to make the bubble burst? Even in Australia.
Right. That's an equity. You're 100% right. It's in Canada too, not quite the same extent as Australia, but big enough to be looming. You're right. Interest rates haven't touched it off because Canadian interest rates haven't really risen that much. I mean, what, 1.25? I mean, you're talking about Australia. I think they're 1.5. And they raised earlier and they've stopped already. They've tried. They really don't want to raise rates to address the housing issue because they're afraid of doing exactly that, touching it off. So it's been on the regulators. All right. and it's worked to some degree. You see construction and housing starts in Australia actually went negative. Home prices are now, severely disinflating. Same thing in Canada. You see the numbers. So it's like walking the tightrope above Niagara Falls without a bouncing pole. I mean, it's one of these things where, pretty much anything could touch it off. And one of the reasons this kind of has come to the fore in the last few weeks is some real issues with some of the mortgage lenders in Australia. I mean, it's insane to the point where Asian banks, Singapore, Chinese banks, banks in Bangkok, were no longer allowing residents to invest in Australian real estate. I mean, think about that. They wouldn't lend money to residents to invest in Australia, to buy land or purchase homes in Australia. And that's ongoing right now. So to me, it's not so much that it's, going to affect the U.S., clearly not directly. To me, it's when you see all these things and all the potential problems and the lack of firepower the global central banks have, it kind of comes back to the Fed, because the Fed and the dollar will ultimately be looked at as the relief valve for some of this if it comes to the fore. I think, Europe is even a bigger problem than Australia. Europe, to me, I mean, look at the lack of a rally in Spain this week. Look at what's still going on in Italy. We've been short the Italian bonds and the Spanish and Italian stock markets for a couple of months, and these are huge, profitable trades. Now, I might cover them here because I think the U.S. could lead higher, but I think this is still, to me, a sell the rally mentality, because the risk versus the reward is still skewed away from the reward right now.
I mean, you look at and how the world markets have performed relative to the U.S. over the last 5 years. I mean, Canada is basically flat over the last 5 years. You can look at China, and if you look at the FXI as a good indicator, you're not up much in the last 5 years. And then you've got the U.S. indices that have more than doubled in the last 5 years. U.S. has continued to be the best place to invest, really. Do you think, like with everything you're saying, all these problems elsewhere, do you think the U.S. remains the best place, or you don't want to invest anywhere just because you think there's just too many problems?
That's the $64 million question. Great question. If I'm investing in the U.S., I'm investing in healthcare and pharmaceuticals.
Defensive.
That's yeah, and they're the best performing sectors, and drug sector is breaking out here, in the face of all this. So it's on its own. It's autonomous. But to the degree that you're absolutely right in what you just said. Now let's look at why. Okay, the reason emerging markets and the reason Europe has not kept pace with the rally in the U.S., the same with China, okay, is kind of twofold. It is, first, the dot plot got really, way overextended the upside in 2014 when the Fed ended QE. More recently, when they started actually following the dot plot for a change, you got rates higher. It drove the dollar higher. You had this big rally from 2014 through, up into 2017. It came off, and then you had another big rally. To me, the Fed has been part and parcel to that. And you look at what's going on with commodity prices too. I mean, it's kind of interesting that the Fed talks about wanting to get inflation to a level where they can maintain it at a higher level. And yet their policies, to some degree, kind of torpedo their own objective in some ways by keeping the dollar high, and that depresses commodity prices, which A, keeps inflation down, and B, keeps emerging markets underperforming. So I think that underperformance will continue. But the flip side of this is equally compelling, and that is the U.S. is ridiculously extended. Everyone's plowed in. Anyone and everyone that wants to own equities owns them. Where is the next growth impetus going to come from? Does this mean the Fed has to turn? Because I don't think what you have on the table right now is going to, fill the bellies of investors, so to speak.
All right. We've been on with Greg Weldon from Weldon Financial. Greg, great insight. Thanks so much for the time, and have a good weekend.
Yeah, you too. Guys do a great job. Thanks a lot.
All right, Joel, 852. Give us some insights here on the.
We're just we're climbing the wall of worry here. Spoos are almost green. We're trying to get green on the session. We got that little pop that Dennis picked up out of the left corner of his eye, and that has continued. We're above mid-range on the session.
Well, they gave that pop back though, didn't they? A little bit, because I was kidding. The comments that
not really. We're up now. So now we're up. From when we started, we were down about, I'm looking at the SPY, down about 70 cents. We started the show. We're up 20 now. So up 9 handles since we started the show. If you're looking at this P futures, doing the quick math.
Yep. Yep. And we are looking at that. I mentioned that closing price from yesterday of 44.25, and your pre-market high stands at 43 even. So, I mean, we're coming back, not big imbalances. I mean, the big meeting this weekend, I kind of looking for a two-sided market here. But do we want to go to any analyst meetings? We want to try to cover some stocks
let's
from
do
the chat?
Let's do AT&T real quick. That was the last one I had on my
Sure.
list. That was the last stock on my list to cover, and then we can go from
Yeah, I have it on my list too.
Nice.
They gave some guidance last night. They guided fiscal year EPS growth in the low single digits and free cash flow in the $26 billion range. And the stock is up this morning, about 1% last I checked.
It is up 0.92%. Dennis, any comments on their guidance? And I can give some.
I mean, as a matter, it's been a stock that just not moved very much lately. I mean, it's trading with a 6.48%. People are in it for the dividend. The dividend is definitely safe for now, in my opinion. It just doesn't move a hell of a lot. I mean, it moves. If you look at, you can even bring up the TLT, and there's definitely a correlation there between that. It trades like a bond now. So yeah, guidance is, it was okay. Wasn't, blowing me away. But, what I find interesting too is how much Verizon has outperformed AT&T in the last 3 months. Verizon back in August was 52. It's now 59. AT&T back in August was 32. It's now 30.
I've been noticing.
So AT&T in that same period is down 1.5 points, and Verizon is up 7 points. So I'm not sure why. These two stocks, I used to pair trade them together, used to work very well. I'll tell you, there's like a decoupling here right now. I don't know why Verizon is doing so much better than AT&T, but that's what's happening.
Could be because they, AT&T just bought Time Warner, and they don't like.
Well, AT&T overpays for everything. There's a good point there, Spencer, too. I mean, the DirecTV probably purchase was a disaster for AT&T. I mean, they basically bought the top of satellite TV. So, right before, when Netflix was coming, Netflix was already in the launch. The tea leaves were on the wall. I don't know why they wanted to jump in and but you can see Dish Network in the last, when was DirecTV merger?
Oh, gosh.
2015? When was it?
That was a couple
Do we know?
years ago. Yeah.
Probably when Dish Network was up at $80. Dish is now $32. So you can just tell, that those DirecTV assets are probably not worth nearly as much as what they paid for them.
Yeah, that was
July. They paid a lot for time. When was it?
July 2015 is when that was.
Right, the high. That was the very high on Dish Network too, and maybe Dish Network's popped up. Somebody thought might buy them as well, but I mean, Dish Network is down 60% since then. So AT&T is notorious for paying too much for trying to find growth. And I mean, if you're, I don't know how they would have. I don't know who was thinking that DirecTV was going to be growing. I mean, Netflix, sure, okay, maybe we didn't know Netflix was going to take off in 2015, but it was already out there. Everybody was already subscribing. I mean, that was right. If you were going to buy something, they could probably bought Netflix back then cheaper than they paid for AT&T. I don't know what the market cap was of Netflix back then, but it was a hell of a lot lower than it is now. So they went the wrong way. They've done a lot of bad deals. They've done a lot of bad stuff. And obviously, Time Warner, maybe they've got some assets that they're going to be able to work with, but they pay big bucks trying to find growth, and it hasn't worked.
I did read a little of the report. I saw some of the comment thinking on here as that they they got the content for the pipes now, and they have the pipes and they have the iPhone users, so they have some long-term plan to take
and they said didn't they say something about a streaming media service here to challenge Netflix here?
Well, everyone said that.
This is we know this is going on, but what was there was commentary coming last night from
AT&T. Yeah, I don't know specifically what you're referring to, but I believe it. Everyone is creating their own service now. Disney's doing their own. AT&T, the head of Warner Media, which of course Time Warner subsidiary, just came out a few months ago and said that they're going to be drastically increasing the amount of content that they produce, TV content and movie content. So yeah, it doesn't surprise me at all that it's going to be. This is going to the same thing that happened. People complained, why they don't like cable because they have 1,000 channels and they don't watch them, and so they cut the cord and they just get Netflix. But the same thing is going to happen again. We're going to get we already have Netflix, Hulu. We have a half dozen or so or more legitimate streaming options, and they're only going to increase. AT&T is going to get their own. Disney's going to get their own. ESPN has their own now. So they're all going to just do the same thing. We're going to get 20 or 30 streaming options, and it's going to,
right. So. And this is why competition is coming for Netflix.
Yeah.
So the ratings on the wall here for Netflix, if you're paying 50 or what's Netflix trading at? What's the multiple on Netflix going for it? Do you have that in front of you, Spence?
Oh, let me look it up real
It's
fast.
come down significantly from where it was.
Forward is 69.
Yeah, so they're trading 70 times earnings here, 100, forward earnings. I mean, and I've got 103 on last, quarter's earnings here. So, it's still trading. So you look at it here and you think, oh, it's cheap at $288. It's not cheap, guys. And if there's competition coming for them, which I think there is, I still think it's a solid rally thing. I think we've seen the all-time high in Netflix. I mean, it's easy to say when it's 120 points away from it, but I don't think we're getting back there to 410. 420. I think this is now competition is going to be eventually coming for them. There's going to be a lot of stocks that eventually maybe do come back and make new all-time highs again. I don't think this is going to be one of them. So, Netflix is great. The House of Cards, I'm watching that. And, they've done a pretty good job without Kevin Spacey there. They produce some great content. The multiple is just too high. So love the company. I still don't like the stock because the multiple is too high, but I haven't been participating in the stock all the way. So I've been wrong about that as the multiple expanded throughout 2018, but it's coming. So, it's starting to come in a little bit here now. And I just think so much competition coming for them.
AT&T, I'll just give you an area of interest for me, and that's the $31 area, and that's not just because you had a pre-market high at 31.06. I'd like to go to the monthlies for charts, and if you go to your monthlies in AT&T, you had 3 monthly highs just above 31, between 31.05 and 31.23. So I'll be watching this one today. I think you clear that area and had a really bad month. I'm not sure what happened. Maybe that was actually I'm working at the weekly here. I believe this was around the AT&T the Time Warner deal. Went from 32.87 to 29.09 in 1 month, and since then that rally's been capped at 31.23. So technically speaking, you clear there, and I think you got green pasture up to $33 area. Your high at the end of October was 33.28, and you can't ignore that nice dividend. So, Spencer, anything else that you want to cover? I know we missed a few stocks in the chat.
Yeah, we missed a few in the chat. Let me see if I can go back and look real fast. If anyone has anything, the last second thing someone wants to cover, speak now or forever.
Those quick ratings. We didn't say any ratings. Under Armour catching an upgrade, I believe. I can't read my own writing. I think it was
Wells Fargo.
WWE upgraded JP Morgan. Goldman Sachs downgraded Bank of America. It's the second big bank. Obviously, Morgan Stanley downgraded them last week. Yep. Now you get Bank of America downgrading Goldman. So everybody's picking on poor Goldman. Yep. Abbott Labs, speaking of Goldman, they're getting upgraded. So Abbott Labs upgraded Goldman here this morning. Yep. So a few ratings for you.
Sony upgraded JP Morgan. Did you mention that one? And a lot of earnings really.
What about Cree? Someone mentioned Cree. They got sacked by somebody today, right?
Cree, did they?
Yeah.
It's down. I'm not sure.
I saw Morgan.
Yes, they did. JP Morgan. Good call. Downgrade to underweight.
Oh, yeah. When you get the sell, that's equivalent to sell. When you get those, they hit the stocks. Always when you look at ratings, when you see the ones that are the most impactful are when you're getting downgraded to sell or underweight. Those are the most impactful ratings because there's not a lot of analysts that come out with sell ratings. There's lots that come out with buys, but there's a lot, when you look, there's typically, the street leans always towards the buy side. So when you get a sell rating on something, people take note and they hit stocks hard on that. And this already traded down 5%. It's at 73.49 here in the pre-market. So it's getting hit on this.
Light volume, but you can't ignore that it's had a major run up from the $40 area from $40.58 up to $46.48. Let's call that like a $6.50 move here, 43 1/4. That'd be an area of support you need to hold. If not, look out. 40.58 was your November 20 low, but once again, being down on pretty light volume. Ending the week here, still keeping an eye on that close from yesterday. That was high of the rebound for the week, 27.44 1/4. Last week's high was right in that area too. We'll have, I'm sure we'll have some news coming out of G20 over the weekend. So if you guys want to tune in to the pre-market prep chat on Sunday night, I'll have some levels for you there to watch the S&P 500.
And that chat is at premarket.benzinga.com. That is our main chat that is active before, during, and after the show. If you missed any part of today's show or any show, you can catch our full archives of our podcast is available on iTunes, SoundCloud, TuneIn, and Stitcher, or just go to youtube.com/Benzinga TV to rewatch us there. Thanks to our guest today, Greg Weldon. Thanks to all of you in our chats. Please remember that all the information and content from our show is for informational purposes only and not meant to be investing advice. Excuse me, I'm dying as we end this week's show. Hope everyone has a good rest of the day. Hope you have a good week, and hope you join us again on Monday.